It's up, it's down, it's all around. AIG continues to give investors quite a ride, and we're going to bring in now Bloomberg's Adam Johnson with the latest on really some interesting developments.
Yeah, lots of, Stay tuned. What a difference a day makes. First of all, of course, yesterday you saw on the New York Stock Exchange website, they said that the company, AIG, was going to be delisted. Well, this morning they apologized. They say, no, that was a mistake. Well, anyway, yesterday also was the first day that we had the reverse 20 split in effect. Recall that the company decided to reverse the stock 20 for 1. Why? Because the stock was trading at $1.16.
I remember because you were sitting right here when the headline crossed, and you pointed out that short sellers would be thrilled.
Quote, all over it. Yeah, you just gave them more opportunity to make more money. The company, of course, did this because they wanted to get the share price above $5. Why? Because institutional investors can't invest in stocks that are under 5. So if you look at where it closed Tuesday, $1.16, should have opened at $23.30. Yesterday, it didn't, perhaps because of the snafu. It was trading down around 18. Well, guess what? Even with the apology out of the NYSE, it's only up 80 cents, maybe $1 today. So it's still down. The real story, Matt, the split, or rather the shorts.
The shorts, right? Because borrowing the stock comes at a price here.
Oh, it comes at quite a price. You know, typically when you want a short stock, you have to borrow it. And when you borrow it, you have to, well, in theory, in a good market, you can actually get paid to do that. When it's tough to borrow, you have to pay money to do that. Well, right now, you have to pay 50%, 50. Okay, you have to pay 50% of the value of the stock on an annualized basis to actually short the stock.
It's unreal. And you called a desk to see if they had any shares?
Yeah, I called the J.P. Morgan stock loan desk. They said that the phone was ringing off the hook yesterday from guys who wanted to borrow it, the short sellers. Today, they had to fail 300,000 shares this morning. In other words, they couldn't cover it. They had to go out and try to find shares. They think they will do that by this afternoon and even be able to loan it out again. But again, if they do, it costs 50%.
So if you want to call J.P. Morgan, you're going to have to pay, though. Let's talk about if we will ever get paid back from AIG. Obviously, a $184 billion bailout. What's the likelihood that taxpayers ever see that money again?
Believe it or not, Atlantic Equities has a piece out this morning. They say it actually is possible. Let me run you through it. Here's how they do it. They say that if AIG sells all of the life business, all of the aircraft leasing business, all of their asset management businesses, and 25% of the property and casualty business, that'll raise $83 billion. All right, now that still leaves about another $50 billion that they have to raise. But they say they can do that by selling the, quote, jewel in the crown. That's the non-U.S. based life insurance. They say if you do that, they can get $40 billion for it. Okay, now they only owe we, the taxpayers, $10 billion, but they say it's close. Meanwhile, of course, you got the shorts who, if they can get the borrow, want to short it again because they think it's going back to zero. There you have it.
If they can get us back, I think $10 billion isn't going to bother anybody at this point.
Yeah, who's complaining?
All right, Adam Johnson, thanks.